Welcome back. U.S. retail sales numbers were released this morning. Spending rose 0.2% in June. That's an increase for the third consecutive month, although that increase was much more modest than has been expected. Economists were expecting a 0.5% increase in retail spending. Excluding automobiles, the number was also 0.2%, also weaker than expectations. Excluding automobiles and gasoline, the number was 0.3%, which met expectations. Let's speak with a senior economist now to get his take. We're joined by Marc Giannoni. He's Managing Director and Chief Economist at Barclays. Marc, thanks a lot for joining us. Your take on these retail sales numbers, first of all.
Yeah, good morning. Thank you for having me. Well, as you said, the headline was weaker than expected at 0.2%. The consensus was quite a bit higher at like 0.5%. But what we really pay close attention to is the so-called control group. So it's a group of categories that is really used to forecast what overall consumption is going to be in the national product account for the second quarter. And here we got some strong positive surprises. So in particular, the control group for personal consumption spending came in strong at 0.6% month on month after revised 0.3% in May. We think this suggests that really consumption overall in the U.S. economy was still strong in June.
What is your take on it? We've just, as I think you know, we've got new inflation numbers here in Canada this morning. It wasn't that long ago that we got new inflation numbers in the United States. Your take was at the time that the news was very encouraging, yet the latest print on inflation exaggerated the disinflationary process.
That's exactly true. Yes, we saw the news was really encouraging, in particular with the sharp deceleration we saw in the consumer price index for June. The data there came in considerably softer than expectation, with headline rising 0.18% month on month. So that's a very soft number here. Part of it was expected, like we had core goods prices falling, especially due to used car prices coming down, but core services softened a bit, and in particular, the so-called super core inflation of services. Once you exclude housing, which we know is gradually going to come down, these services prices that are excluding housing, as I said, they decelerated considerably in June, and that was a very, very good news. But we do think that this is exaggerating the decline. The categories that led to the pullback are notoriously volatile, such as core services in airfares prices, hotel prices. We don't think we are going to have a continued trend downward in those categories. And so we think that CPI inflation in the U.S. is going to continue to evolve to result in a 3.6% year-over-year growth rate by the end of the year.
One factor playing into it is the very tight labor market. It is here in Canada as well. Can the Fed bring inflation down without increasing the rate of unemployment?
Well, that's where we are somewhat skeptical. I think, as I said, the news were very good. We got some categories like coming down. But at the end of the day, income remains really strong in the U.S. economy so far, at least through June. We think that continues because of this tightness in the labor market. We keep bringing in over 200,000 jobs into the labor market. So employment keeps growing. Income are growing, that fuels consumption, and we saw this morning for the control group, at least for retail sales, that's still strong in June. And we think that's going to lead to continued price pressures. So no, I don't think that we can get to consistent, persistent 2% inflation over time, which is the Fed's target, without a softening of the labor market.
How many rate hikes ahead from the U.S. Fed do you see?
So we have one rate hike penciled in for the July meeting. We are pretty confident about that. I think this is largely expected by the market. But we do have a second rate hike as well coming in, either in September or November, as the Fed needs to, we think, soften the labor market and cool down the economy in order to bring these inflationary pressures down on track to the 2% target.
One of our earlier guests this morning believes that both Canada and the U.S. are headed to a mild recession. Do you believe that the U.S. economy will be slowed into recession by these rate hikes?
We do think that that's going to eventually happen. The timing is really difficult to predict with any precision, but we do think that over time, these rate hikes, over 500 basis points so far and more to come, will slow down the economy. I think it's more likely than not that we'll have a mild contraction. I don't expect a severe contraction, but I think we should be prepared for a mild contraction.